We feel a sense of responsibility to deliver the highest possible standard of clearing solution to the market. One of the ways in which we believe clearing will improve liquidity is by implementing some of the key features that we saw in the swaps market. If you introduce immediate clearing, you eliminate bilateral counterparty credit risk, and you create opportunities for more people to trade with different people and more people. In theory, that should improve liquidity. We have to implement this, the market has to choose this, and we have to compete on the merits of the offering versus CME or versus FICC.
What are the drivers behind the recent clearing mandate for Treasury securities?
If you look at certain work that the TMPG did and work that the IAWG have done, there's a perception that the Treasury market could benefit from greater resiliency, greater transparency, and some modernization effectively to bring it up to the same level and same speed as other markets. Periods of stress during things like March 2020, where people were able to compare, for example, the swaps market with the Treasury market, allowed people to think, hey, where is there room for improvement here? The Treasury market has evolved enormously in the last 20 years. There's a very different mix of players. It's become much more high velocity, much more electronic. So it was probably a good time from a regulatory standpoint to think about what the next 20 years look like. There's quite a few different changes going on, but clearing is one that I think many people believe will bring greater resiliency and transparency and innovation to the market.
How does ICE plan to differentiate its offering and gain significant market share?
The interesting thing about this clearing mandate, unlike the Dodd-Frank clearing mandate, this mandate is much less prescriptive. So there's a lot left up to the imagination for the clearinghouses to compete with each other. Now, where you don't typically want clearinghouses competing is on things like risk, right? You want it to be resilient. You want the standards to be fairly standardized, and the regulators and clients and everyone, investors, to feel very comfortable about the resiliency of the clearinghouse. But our model is very different to the FICC model. For example, we believe that the swaps future style clearing model, which ICE Cleared Credit is very relevant and active in for credit default swaps, we believe that's the model the market will gravitate towards. It's the most recently designed model in clearing. There was a lot of features that the market wanted to see. A lot of those features are not present in the FICC model. So we think our model will offer clients a choice to choose a clearing solution that looks a lot more like swaps or futures.
What does the clearing mandate open up for ICE?
First and foremost, it's an opportunity to extend and expand on the innovation, the technology, the great team that came together at ICE to build ICE Cleared Credit. It is unusual that we have a new clearinghouse like ICE Cleared Credit developed in relatively recent history as far as these markets are concerned. 15 years is pretty young for a clearinghouse. So there's a lot of great innovations, great work that was done by the team and by the firm to respond to Dodd-Frank. Today they have a close to dominant market share in CDS, and we think those features are going to be very exciting and relevant to the Treasury market participants.
With the mandate bringing more participants, what efficiencies do you anticipate from market participants?
It does depend on implementation. However, if it is implemented in a similar fashion to the way swaps was implemented, we'll see a substantial reduction in the amount of complex documentation required to trade these products. That unleashes a lot of potential in the market, a lot of efficiency. We look at a lot of netting benefits that you get from clearing. Today the Treasury market is quite fragmented, quite convoluted. If you have your trades going into a central location, there's a lot of netting potential. There's a lot of margin benefits from clearing your portfolio through an FCM, whether it's one FCM or two FCMs. And of course, like we talked about, it unleashes potential on the liquidity side to give people better execution, faster execution, more transparency around pricing.
How will this mandate impact clearing members in terms of capital requirements?
That question, to be honest, is still an evolving discussion, right? Clearing members, for example, typically large banks who offer clearing services to their customers, tend to be governed by many different capital regimes depending on where they're located. So what we're working on right now is crystallizing the rules and crystallizing the framework that we will offer to the market. in order for those market participants to analyze those rules and the structure from an accounting standpoint, from a capital standpoint. And we're continuing to partner with them. Things may need to change and evolve. The goal, of course, is to at least make it economically equivalent to the current market, but ideally make it better by reduction in RWAs, optimization of collateral, optimization of single counterparty versus multiple counterparty. So we think it should be better, but the analysis is still ongoing and does vary by market participant.
What technology is being developed for smoother, more transparent Treasury clearing?
Even though these specific rules, the SEC rules for Treasury clearing, they do not mandate or specify how quickly clearing needs to happen. They leave that unspoken. One of the things we're doing at ICE is we're looking at the standards that were set by Dodd-Frank, which were actually very precise and very, very high standards, which mandated that clearing needed to happen almost instantaneously. So even though we don't need to do that in this case because the rules don't require it, that's what we're going to build. That's the standard we're building to. And we're building to that standard because the quicker you can get a trade into clearing, the more seamlessly you can STP trades from the point of execution to the point where the clearing has happened, then the faster you eliminate bilateral counterparty credit risk, and the quicker you bring all the benefits of clearing to the counterparty and to the trade. So we're deploying the technology that was built for swaps clearing. As I said, even though that's not necessarily mandated here, we think that standard is high, and we're going to try and bring that to the Treasury market so people can benefit from the same velocity of clearing and elimination of bilateral counterparty credit risk instantaneously at the point of execution.
How will Treasury clearing affect ICE's data business?
One of the things ICE does from a data perspective is, as it operates in many, many different areas of the market, bringing that mosaic of data together and packaging it in such a way that clients and investors can use the data, look at correlations across different components of data. That's the thing that brings a lot of benefit to people. If you just have Treasury market data on its own, that's incredibly valuable. If you link it to other market data and package it up in such a way that people can look at a whole mosaic suite of data together, that tends to be very valuable and very in demand. So by being right front and center in the middle of the Treasury market, by being a major player in clearing, we should be able to generate the same kind of sophisticated, valuable data that we can add into that mosaic for our customers.
How does the clearing mandate change ICE's risk management practices?
The short answer to that is it doesn't, right? The risk standards that we have are very similar to what we're going to deploy for Treasury. So one of the benefits of having built ICE Clear Credit in response to Dodd-Frank is that was a new, default fund structure, customer segregation models. All of that stuff worked really, really well. The regulators are very happy with it. We have a dominant market share in CDS because customers voted with their feet and choose and believe in the resiliency of ICE. They believe in the risk management infrastructure and the people behind it. So the idea is to replicate that and roll that out for Treasuries and not to change it in any particular way. We think it works really, really well, and we think the market likes it and clients like it. So the plan is to extend it rather than change it.